to have you all here at this Treasury Corner today, since we will be discussing a very significant and interesting topic for all treasurers. Before starting, we would like to inform you that this meeting will be recorded, so we have this available in our YouTube channel. Moreover, there will be time for a short Q&A session at the end of the presentation, so please feel free to ask any question only through the chat. So, as everybody knows here today, Treasury's primary responsibility is to ensure that the organization has always sufficient liquidity to meet all the obligations. Being able to forecast the cash flow is one of the most important and fundamental elements of Treasury management. So thus we are here today to discuss this hot and fundamental topic and find out how a cash flow forecast is planned and managed. Sotiri, good afternoon. Can you please share with us your view and let us know how, first of all, what is a cash flow, how important cash flow forecast is for you as a treasurer, and what kind of benefits an accurate cash flow forecast can bring to your organization?
Hello, everybody. Hello, Manos. Hello, Yorgos. With simple words, cash flow is the cash or cash equivalent which the company receives or gives out by the way of payments to his creditors. Cash flow analysis is often used to analyze liquidity position of the company. Generally, cash flow forecast is a fundamental part of cash and liquidity management, and the treasurer should always have an accurate forecast available to ensure that is always available cash in the right place, in the right time and the right currency to meet his short-term and long-term obligations. Having an accurate cash flow forecasting can give us many benefits. It can improve us liquidity management. It can minimize the interest expenses, minimize the cost of debt, maximize interest earnings, and improve our working capital management. At this point, we would like to welcome George Sinidis. George Sinidis is the Credit Controller and the Treasury Director of WIT Hellas, and with many years' experience in Treasury and apparently cash flow forecasting. We are happy here that he will provide to us his insight and his methodology to cash flow forecasting and significant KPIs for his day-to-day operation. George, thank you very much for joining us in this Treasury Quarter today. So how important is cash flow forecasting for you as a Treasury Director, and what kind of KPIs you mainly targeting?
Hello, everybody. Thank you very much, Sotiri and Manon. I'm very pleased to be today here with all the Treasury Association. And okay, cash flow forecasting is Treasury's primary task. I cannot imagine a Treasury department without cash flow forecasting. It's imperative. Regarding the KPIs, as you mentioned earlier, the most important is liquidity. Liquidity is being calculated, considering, of course, taking into consideration timing, proper closing balance to certain time periods. We all know expressions like cash is the king, and companies do not bankrupt due to negative profitability, but due to lack of cash. Cash should be our main priority as treasurers. Other than cash, we should focus on net working capital. Formal definition, but I'm not going to stay on that of working capital. Is the variance between current assets and current liabilities. Practically means that we should target to positive working capital in order to avoid in order to be able to finance our company. By monitoring our working capital, we are able to understand which of the activities of our company finance us and which from we are financed by. Thank you.
So for George, cash flow forecasting is really crucial, as we can see, and help him a lot in managing the working capital. At this point, let's remember which are the main types of cash flow forecasting we can utilize as treasurers. So the two main categories as we know, is direct and indirect cash flow forecasting. The direct method determines changes in cash receipts and payments, which are reported in the cash flow from the operations section. The indirect method takes the net income generated in a period and adds or subtracts changes in the asset and liability accounts to determine the cash flow. So, having said all this, George, in your case, which method are you applying and what kind of advantages or disadvantages do you see for each method?
We are applying, actually, we are applying both methods, direct forecasting and indirect forecasting. Our primary tool, and we use it on a daily, weekly, monthly basis, our direct forecasting. But occasionally, sometimes once in a year, we are doing an indirect forecasting exercise, and we try to match direct and indirect. Both methods have advantages and disadvantages. Direct forecasting is very accurate tool for short-term periods. I would say, from my experience, up to 3 months gives adequate accuracy. More than that, we are losing the accuracy since we use trends rather than actual data, which means that we are losing a lot of visibility. But for short-term periods, we will be able to project with great accuracy on a weekly, even on daily basis. And we can provide, we can have an early indication about shortage of cash. Another benefit that's that we have a very clear depiction of our inflows and outflows. We can review normality versus seasonality. We can analyze trends, or we can spot extraordinary items. As I told earlier, the main disadvantage of the direct cash flow is the poor visibility. But not only that, it's the lack of comparability. Even though we can have a straightforward trend analysis, we do not have the absolute sense of the collected and paid figures. I could say an example. Let's say that our collections are improving compared to previous months. Of course, it's good. It's good. We are satisfied. But how do you know if it's is it good? How good it is? Is there the possibility to be better? Is there a probability for invoicing to have increased a lot higher than your collection, and actually you are losing funds? Of course, there is. But the direct cash flow does not provide such information, and you cannot judge it. The most appropriate instrument for that is the direct cash flow, because we are receiving the working capital analysis. The advantage of the direct cash flow is that enable us to have long-term projections. We can use indirect method for 12, 15 months period, or we can use it for a business plan for 5 or 7 years ahead, which direct is it's absolutely useless. And we can analyze, we can receive the working capital analysis, and we can understand in depth of the thesis of our operation, what activities are creating cash, and what activities are consuming cash. We have straightforward KPIs that like DSOs and DPOs. And of course, nobody, there are disadvantages as well. We have a very poor short-term accuracy in forecasting. We're losing intra-month fluctuations, and we should be very careful for for not taking into account non-cash items.
So, George, how exactly did you manage to go from indirect to direct cash flow? Which is your key to having an accurate transition and combining the advantages of both methods?
Let's give me just 2 minutes to describe the background. First. Our previous BOD required to receive an analysis of the actual net working capital on a monthly basis, meaning that we should be able we should be in the position to explain variances in receivables and payables in a more structured way. We should be in the position to justify in a subjective manner the key movements in our net working capital, and actually we do not have such information or a tool, meaning that we should create a tool providing further information and in-depth analysis of the movements of working capital. For example, knowing that there is a negative change in our account receivable did not give a lot of information actually. We should split the account receivable and payable in subsectors and realize which subsector created the big variance and what is the justification behind that. And the subsectors that we had in line and were the more significant ones were the subsectors of our direct cash flow. So the only solution was what we concluded is that we should be able to create an indirect cash flow, but to split the movements in the categories of direct cash flow. I will disappoint all of you that imagine that we had an IT application, but we created the tool in an old-fashioned traditional Excel. So it means a lot of manual work. Okay, but I will describe shortly. I will give you a brief description of the methodology, and then we can go step by step. First step is to do the P&L mapping. We received the P&L and selected the cash-related items and split in revenue and cost, and we categorized them in accordance to the categories of our direct cash flow. Second, we recreated, we built from the beginning a working capital calculation on each category, meaning that we started from an opening balance received from the balance sheet. It's just a typical circle, a typical moment. You begin from an opening balance, you add new invoices and taxes, and then you are subtracting the payments of existing and new invoices. And you are closing, you should reconcile with the closing balance again with your balance sheet. The outcome of that is two reports. One is working capital analysis, but split in the categories of direct cash flow. And then we matched it with direct cash flow in order to be confident, to be very confident that the cash circle closes perfectly. I mean, the two reports are reconciled with each other and with themselves. I will just to give you a brief description of what indirect cash flow looks like, and then a direct, and then we can go step by step to the methodology I described. Okay, we have, it's a typical indirect cash flow, meaning that we start from EBITDA or cash EBITDA, or in sometimes net income. We subtract capex, and we have the operating free cash flow. From the operating free cash flow, we add or subtract changes of net working capital, inventory, and trade receivables and payables, and we close to cash from operations. And then we should consider the non items that are extraordinary or finance related, and they are not being included in EBITDA and P&L. So we have the final change in cash, meaning that we are able to have the cash opening and the variance is the cash closing. And then this is a typical direct cash flow, meaning that we have the main categories of collections and payments. When I mean main, it's categories that have a significant substance or very different payment terms. And we have again the non-operating receipts and disbursements, and then we conclude on a certain cash closing balance. Okay, having a brief picture of what direct and indirect is, I'm going back and going to the first step, which is P&L mapping. We received our P&L and we split it in the same categories that were the inflows and outflows of our direct cash flow. It's not an easy work. It's rather vague work. I mean, it's not a straightforward process, and we should take care to include our P&L items resulting to EBITDA. I mean, EBITDA should be calculated internally, and categorization it's difficult, but it's crucial. I mean, we should insist on that, and we should also consider that various P&L lines matches with different categories, so we will be able to split in both lines or to merge lines according to the categories that we should receive. Since we do it in all categories, the outcome is to have a P&L split in revenues and cost, but again with categories of a direct cash flow. As I told earlier, EBITDA should be calculated internally.
George, this cash flow forecasting method is really interesting, but I guess it's also very challenging for the finance team, right? So actually, how many departments need to collaborate to have this outcome?
Okay, that's a very tricky and a very good question indeed. Just have in mind that it's not a straightforward treasury project. You should consider it as a CFO project. Of course, Treasury is the owner of the conductor of the process, but we need the commitment and serious involvement of accounting and planning and controlling. I would say that this is the most important, and this is more difficult than the process itself. I mean, to convince the other departments that it is part of their work and to cooperate with Treasury, then the project is more difficult than the project itself, according to my experience. We should persuade them and to obtain their assistance and their involvement. They should not consider that they are just assisting Treasury in a subject that is relevant of their job. They are contribute to their working capital and to the working capital analysis and provide proper information for the top management to receive respective decisions about the activities of the company. That's very, very critical and depends on the CFO to implement this culture between the departments. And to be more specific, we start from an opening balance, from the balance sheet. This is a balance sheet which be categorized in certain categories, and this should be done by accounting department in a very certain and subjective way and uniform. You cannot change the methodology month by month. Then we're receiving the new additions of invoices from of each category from P&L, like the method we described earlier. And then the Treasury inputs collection and payments, depending on if it regards of unwinding of old balances, I mean, balance that already exist in the balance sheet, or new additions. The old balances should be unwinded considering normal trends based on actuals, and the new invoices should be unwinded based on existing collection and payment terms. And if it's all to be done in the right way, this should be adding to working capital to the closing balance of the certain item. So in our example, we begin from an OPEX payable. We add the additions, the new additions. We subtract all the new payments, and we are closing in a balance at the end of period. It's a rather perfect example. Practically, it does not happen to be very so accurate. So please have in mind to leave a line for minor adjustments in order to reconcile the opening and closing balance. The variance between these balances is, of course, the working capital. And now here's the key point that combines indirect with indirect. The movements of old payments and new payments regard transactions of our direct cash flow. So if we receive in each category the movements that regard collections and payments, we have the translation to our direct cash flow. So the big picture is that we have an indirect cash flow split in all categories of a direct cash flow, where from the one point is that we are calculating the working capital variances, and then we are able to receive data in order to calculate a normal direct cash flow. This slide is the most, I think, the most important, and it's the heart of the combination of direct and indirect cash flow. And
George, having
Sotiri,
said
you're
all
muted.
this, a key question that all treasurers are asked to reply is how we can come up with a proportion of profit converted into cash and how we get this information.
Okay, if following identical methodology on each category, the outcome is net working capital analysis. We can see on the left, in which you can see not only where we gain cash or not from the movements of payable or receivables, but from which specific area. The positive variance concern profit converted in cash, since the negative variance concern the opposite. Let's take an example. The movement that we can see in OPEX in August, it's plus 5.5 million, means that there is an increase of accounts payable. If we go to the analysis that shown earlier, we can drill down and understand where the cause of the variance. It might be higher invoicing, it could be less payments, or a mix of both. So we have an analytic snapshot of what's happening, the causes behind that, and not only the payables, but the specific category of the payables that creates the variance. I mean, if in our previous analysis, when you see just an increase of payable, you cannot give any justification about that. And the second outcome is direct cash flow. This direct cash flow, which is exactly an outcome. I mean, you don't put anything here manually, and it's in an ordinary format, since we have already considered and used the categories of a direct cash flow. And the cash balances, the most important is that the cash balances of the two reports reconcile with each other.
George, in the beginning of this presentation, you mentioned and you stressed out the significance of working capital KPIs. But at this point, let's clarify what is working capital and what are the factors that can affect it.
As we have mentioned before, practically the change in net working capital reflect activities that we finance and activities that we are being financed from. From monitoring the fluctuations of working capital movements, the main KPIs are DSOs and DPOs. DSOs are the days sales outstanding. DPOs are the days payable outstanding. The lower the KPI it is, the faster conversion to cash. In principle, KPIs of each DSO should be very close to collection terms, I mean to sales terms, and DPO should be very close to our payment terms to our suppliers. Just to give an advice, I would say that DSO and DPO are very influent in fluctuations, so we should consider taking averages, 3 months average, in order to prevent abnormalities that could give false alarms. If we find a great deviation of the payment terms I described earlier, it's an alarm itself, and we should be able to explain and find the cause of it. Furthermore, factors to improve working capital and respective KPIs. Generally, the aim should be it's very simple, to bring collections earlier or payments later. Okay. For collections, we should focus on aging, spot overdue amounts, try to obtain collections prior to become a bad debt, and give motivation to external collaborators if we have for collections, and to the customer in order for both of them to bring collections earlier. we can change the terms of sales, whether it's achievable. And we should also consider banking tools like factoring or sales of receivable. For the payment, change of payment terms is if it's acceptable, and of course, again, if it is achievable. And another idea is to try to conduct bilateral agreements with your collaborators, driving to mutual benefit. I mean, better pricing in accordance with different payment terms, or an extra cost on behalf of extending prolongation of payment terms. Of course, we have again bank instruments like reverse factoring or forfeiting. Just to summarize, this is a typical cash flow statement that we can receive, and it starts from EBITDA, calculates and forecasts the operating free cash flow, calculates the change in net working capital in all categories, inventory, receivables, and payables, but with the ability, it's the great variance here, the ability to drill down and to be able to explain the cause of any actual or projected fluctuation, variance, and then you can plan the right action for improving that and bring the result that you wish. But of course, we have extraordinary financial and not EBITDA related items.
George, what were the main issues that you faced while you were trying to set up this cash flow forecasting process, and which are the traps treasurers may encounter and should avoid when they try to set up a cash flow forecast?
That's a good question. That's a very good question, and I would give the best of my knowledge based on my experience working on that model. Just be aware that we are working this model since 2010. I think the last 12 years. So we have a great experience about that, and I can. The things that I can imagine, that I can advise, and what you should do and what you should avoid. What you should do you should be very scholastic while you're drafting your P&L mapping. Take a lot of time to schedule to draw it in a very well manner, because it will follow up. It will follow you for the next sessions. Be as accurate as possible. We have mentioned it before, try to exclude any non-cash related items. Find a uniform and subjective way to categorize balance sheet balances. Accounting should be able to undertake that. It's not easy. But we should insist on that. It's crucial as well. And of course, the categories, I mean, the balance sheet and the P&L should speak the same language. I mean, when you're beginning from the balance sheet, you should be able to add the certain item from the P&L and not something else. Take care of phasing of invoices, equal total invoicing amount result in different working capital results when phasing is different. That's very tricky. And let's have an example. If in a certain category, let's say in OPEX, the 50% of the value of your invoices are being booked in the last 2 or 3 months of the year, have a great impact in the current year. I mean, you are improving your working capital, and of course you are paying it for the next year, and you should do it every year in order to have a constant performance. So phasing is very important, and try to understand in depth the mechanics creating working capital variances to be able to explain the cause of the variances. Take out of the extraordinary items and be very specific on the items that create variances on a constant way, and then be able to improve and propose ideas for improving the working capital. Some items that you should avoid, some things that you should avoid. As we were told earlier, the most difficult is to persuade and convince all the other departments of a CFO directory that it's not exclusively a treasury project. Believe me, this is the most difficult than the project itself. I told it earlier, and I believe it very, very strongly. We need the improvement and the assistance of the other departments. Second is that all this exercise has a degree of accuracy. It's not a straightforward process that do not expect that it will match 100%. Be happy if you have matching of your figures between 80, 85, 90%. I think it will be great. But don't be afraid. It's very, very sufficient to explain the variances and to take the right decisions. Don't be afraid about this discrepancy in the accuracy. In the first years, we are focusing on that, and we are losing a lot of time without any significant improvement. I mean, we will benefit rather than without receiving any significant benefit. Another issue is that do not try to split indirect in too many categories, because it puts complexity. Sometimes we're trying to gain accuracy, but we pay it in complexity. That's a mistake too. Try to have certain categories that have a great meaning, have different payment terms, and have a great substance in your activities and the amounts that you are monitoring. And last, I would think is that do not try to calculate VAT externally. Should be calculated internally by the model based on the projected or actual invoices in both revenue and cost. I mean, you should be able to consider that VAT created as receivable minus the VAT created as payable, and then to be calculated internally. That's my experience so far. So I'm very happy that I had the opportunity to share it with you, and I would like to thank you very much about the opportunity you gave me.
George, thank you very much for your insight and the great presentation, and congratulate for your excellent effort and performance. Short conclusion of all this is if we want to have a short-term cash flow, we should use the direct method. And if we want to have a long-term cash flow, we should use the indirect method. Combining these works, we can get significant KPIs that they can improve our liquidity management and get very insightful conclusions.
Exactly.
Now,
we can combine both words and have the benefits of both.
Now we should give the audience some time to have a Q&A session, and feel free to put your questions in the chat.
So are you going to read the questions, or we're going to see it in a text?
Yeah,
We should,
let's wait for questions to come,
Okay.
and we're going to read them. Okay, we have a first question from George. He's asking, somewhere in the slide 3 or 4, there was a figure invoiced capex in the cash flow reaching the free cash flow. Could you please further explain?
3 or 4.
I think it was
Invoiced capex. Can
yes.
you repeat the question?
Yes, invoice capex.
Okay. Capex is not a profit and loss item, so we should subtract from the acquisition. We have EBITDA. In order to calculate the free cash flow, we should exclude capex, and then we should calculate all the net working capital. Capex is should be out of this acquisition. Because capex is not an expense.
we have
Another
one
question.
more. Yeah.
Another question
is regarding the connectivity and how exactly this forecast and this Excel is fed. So Elisa is asking if you have an interface with your ERP in order to feed with data your Excel.
No, it's not connected to our ERP. We are receiving the balance sheet, of course, from the ERP, but we have created a tool that receives the balance sheet and categorize it itself. So that's an improvement. And since we receive the balance from the balance sheet, all the other work is being done manually and out of our ERP system. So the only involvement is receiving the balances and creating the categories and the balance for each category. The other, of course, P&L is being received from the system, but the mapping is being done on a rather manual way, and all the calculations are Excel based. But there might be, depending on the ERP system and the IT involvement and willingness to be involved, I think that there might be an automation here. And of course, I don't know if there are tools outside there that are providing this type of information as well. But no, I'm not aware if a treasury management system or another system could provide such information.
And George is asking that his questions about the deal with the invoice, why we should deduct solely the invoiced capex and not the projected capex, growth, maintenance, etc.
No, it's all. I mean, this is just an example. All the projected capex should be here. You can see should be excluded as well, and maintenance if it's been booked as capex as well. Yes, indeed, he's right about that, and we are just considering operating expenses and receivables for calculating the EBITDA internal. But he's right about that, yes.
Another interesting question, I think it's from Mariana. When incorporating factoring in the cash flow forecasting model, isn't it possible to have also a cost-benefit analysis, meaning the increased cost of factoring versus the cost of the days saved?
That's a very interesting question indeed. We have not done it. We can calculate out of the model, but yes, you should be able to calculate the cost of funds. I mean, versus the benefit that you are receiving funds earlier versus the cost of factoring. That's an exercise that we do it outside of this model in order to receive our decision. But yeah, that's very interesting indeed.
Another question is, what about the dependency on other departments, divisions? Do you request info on a regular basis or you stick only on finance source data?
Of course, for planning and controlling to create a budget for the department receives data from all other departments, from all the company. But we are running this exercise about 4, 5, or 6 times a year. We started from the budget, so we work on that and are planning the working capital of the next year and the cash balances starting from the EBITDA and working capital. And of course, when we run the exercise, it's just internally a CFO department, but prior to that, all the company has been involved. I mean, I receive the budget as given, and I'm running this exercise. And then we update it whenever needed, whenever have a great variance, or we are just updating it in the run monthly. We make a 3+9. I mean, 3 months actual +9 forecast, 4+8, and going forward. So we're monitoring how close we are to the budget and what actions should be taken in order to go close to the budget. But for this exercise, only CFO department is being involved.
Another question from Iliana, I think, which you have already partially answered this, regarding any automations that they would probably help you, doing in a faster way this forecast. So Eliana is asking if do you think it's possible to use any treasury tool to improve the automations?
Yeah. That's yes, I have partially answered that. That's my aim too. Our aim. I don't know if we should. I have not done the inquiry yet, but I'm seeking to look at treasury management systems that could create such information. I'm not aware of that. just imagine that we have started so many years before. So I don't know what is the evolution of the treasury management systems and what they could do for that.
I think, Sotiris, this is something that we should also investigate further.
Yes.
But that's very interesting. I would like to be involved.
Definitely.
One more question from Nikos. Any tips about isolating CapEx from OpEx?
If there is any reason for isolating?
Any tips about isolating CapEx from OpEx?
That's very tricky too. In the P&L, it's very easy because it's very straightforward. The most difficult is when you are putting the actual payments. It's not very easy to distinguish capex from opex. I mean, you can pay a supplier that from the same payment he is receiving funds from opex and maintenance and the capex as well. So it's not easy to distinguish. Sometimes we in big payments we split it or try to split in where the sources are, and sometimes we do a round up and say, okay, this is a capex supplier, main capex supplier. I mean, if it's the 90 or 95% of its payment regard capex, so we put it as capex. But he's right. It's not easy. It's very difficult to distinguish capex and opex, and that's a reason of discrepancies. And as I told earlier, we should leave a line for considering adjustments just to close these gaps.
Okay. Any other questions? I don't see any other questions. So I think we can continue, and thank you very much, George, for this really interesting presentation and your insight. It was really helpful. Sotiris, also thank you very much for this webinar. So thank you everybody for joining this Treasury Corner. Our hope is that you have found this webinar interesting and helpful, so you can utilize as treasurers and consider the insights George has just shared today. We wish you a very nice evening and keep in touch. More Treasury Corners will follow up in the near futures, and see you soon. Bye-bye.
Bye. It was a pleasure, and I was honored for that presentation. Thank you very much. Have a good night.
Good night to everybody.
Bye-bye.